Welcome to the presentation. The title of today's webinar is How to Value Stocks. And as mentioned, we believe this is to be an extremely important topic that we all need to understand, because all profit and loss from our personal investments come from the price we pay. And if we don't know a ballpark figure for the intrinsic value of a stock, we don't know if we're overpaying or underpaying for that. So this is paramount to successful investing, especially on the value front. Now, a quick disclaimer, obviously all the information we present here is the best of our knowledge, true and accurate. If there is a typo or a misprint or something, please forgive the fact that we are human, but every attempt is made to present true and accurate information here. Now, you'll notice this little box, and when you go to any stock, in any of the valuation tabs on GuruFocus.com, you'll see this at the top of that stock screen. And I want to show you what each of these components mean, because it'll really shorten the time it takes you to identify whether or not you might have a good opportunity. So obviously we're going to show you the ticker symbol here and the name of the company. First thing here is a star rating. You'll see this from 1 to 5, and what this is a business predictability rank, and we've got a custom built algorithm that monitors both the revenue and EBITDA of a company, and then ranks it 1 to 5 stars based on its consistency and predictability. Now, there are lots of studies done, some by Charlie here at GuruFocus, that have demonstrated that more consistent and more predictable companies not only provide better downside protection, but also outperform the general markets over the long term. So that's why we identify that for you immediately. Gives you the day's action, whether it's up or down on the day, as well as volume when that was last updated, and then some auto-generated good, medium, and severe signs regarding that stock that are available for premium members. Now, in addition, on the right side, we give you a very quick glance at a handful of valuation metrics, and we'll cover each of these today. They include net current asset value, the tangible book value, projected free cash flow, median price to sales, and the gram number. And you'll also notice there is a dotted line going vertical. So what this shows you is any of these bars to the right of this dotted line, the dotted line represents the price of the stock, and then the colored horizontal bar represents the value based on that method. So the more bars to the right of this dotted line, the more undervalued the stock is thought to be, and the more bars here to the left of that line, the more overvalued it's seen to be based on that valuation model. So I just wanted to give you that. When you quickly look at a stock, if you see, a dotted line way out here, way to the right of any of these candles, then it's probably overpriced based on traditional metrics. However, if it's way back over here, the odds are more in favor that the stock is undervalued based on traditional metrics. Finally, a couple of quick reference points for a stock: its market cap, enterprise value, which is the market cap with debt or excess capital included, the price to earnings multiple, and the price to book multiple. Okay, so we'll cover each of these in depth and kind of show you how they work, how you can have them auto done using GuruFocus, or how you can get a ballpark valuation for yourself. So first of all, it's important to realize when we're putting capital to work that not all stocks are created equal, and not every investment has the same objective, right? I mean, sometimes you buy a stock for 5, looking to sell it as soon as it gets to 10. Sometimes you buy a stock that you hope to hold for 10, 15, 20 years going forward. And this is kind of just a quick grid I put together to outline the different types of investments, what gurus championed those, and kind of the investment goals. So the first, these nets or asset plays, and any of you guys who are familiar with Warren Buffett and Benjamin Graham know that this was Graham's bread and butter, and it's really the school that Buffett came from. But what he would do is look to find these stocks trading for less than they're worth on paper, and as soon as they reach that value, they'd sell them. So it's kind of what's known as a cigar butt investment, right? It's worth 8, it's trading at 5. You buy it at 5, it's got a couple of bucks left, but when it gets to 8, you're dumping it. You have no preconceived notion that this will be a $10 and $20 and $30 stock going forward. Ben Graham, big proponent of this. Walter Schloss is a fellow student of the Ben Graham School, one that Warren Buffett called a super investor who had a phenomenal 50-year track record doing just this, just low price to book companies. And this is really how Buffett started out. I put early Buffett there because his investment philosophy has really changed over the last 20 or 30 years. But when he began in the 60s and 70s, this is what he was doing primarily. Now, secondly, when you're talking about mature, stable companies, okay, this is like Dow 30 caliber stocks. We're talking Walgreens, Procter & Gamble, Coca-Cola, big, huge, multi-billion-dollar enterprises that don't double and triple in a year, but they're great long-term holds, primarily found in traditional mutual funds. Now, for these, we're looking more for steady, long-term returns, right? And this is really what Buffett champions today. He wants companies he can hold forever. He wants top quality businesses with huge moats, just trading at a decent price. Howard Marks is another fan of these types of stocks. Peter Lynch did a lot of this when he could buy them at a discount. And again, just looking for, 20, 30, 40% of the course of a year, and just looking for stocks that will continually increase in value, and let that compounding growth go to work for you. And then finally is the category of growth stocks. And this category is always tough for value investors because we want to pay rock bottom prices for stocks, and that opportunity is not often there in the growth category. Now, Peter Lynch is probably one of the most successful growth stock investors of all time. Carl Icahn's another big fan of growth stocks, but these are really big return, higher risk investments. And the risk, again, is all dependent on the price you pay for that company. I mean, there's a price for any stock to make it low risk. But generally, these ones we're going to have to pay up a little bit more for, but we still want to have that value mindset. So we want a different valuation model to, value one of these versus valuing one of these. Okay. So let's start with the net nets, or also referred to as asset plays. These are probably the easiest stocks to value, and from my experience, is the easiest money you can possibly make in the stock market. The problem is there's not a lot of them out there. They're difficult to find. When you do find them, they tend to be micro or small cap stocks that are very much overlooked and can't be bought by some of the larger funds. But the valuation model is known as their net current asset value, and this is one of the ones in that that box at the top of any stock. And this is the formula for that. So it takes the total cash and equivalents. That's just literally cash money, and securities, stocks, bonds that can be converted to cash within a year. It takes all the cash, and then it adds accounts receivable, so money owed, whether they shipped out an order and are waiting to get payment, whatever that may be, multiplied by 75%. So what this does is cook in a 25% margin of safety, though. So if they're owed, $1 million, it says we'll count 750,000 of that. So just in case 25% of their customers don't pay them, we still feel pretty safe. And then it adds in finally inventories, and this is things there, whether it's raw materials, whether we're talking about a steel company, if it's Apple, we're talking about iPhones and iPads and things sitting there waiting to ship out. They could be in the production process, and we haircut these by half, so we give them value for 50%. And the reason is just simple. I mean, inventory is the value they carry on the book, may or may not be what it's really worth, right? When it comes to a net, we want to look at worst case scenarios. So if it's an IBM or a Hewlett Packard, worst case, they go bankrupt, they have to fire sale all their stuff. Maybe they only get 50 cents on the dollar. Technology tends to devalue quicker than others. Maybe a steel company, maybe their raw materials are worth more than someone in more variable business like technology. But as a blanket method, we discount those by 50%. And then we subtract total liability. So every dollar they owe. And there's no need to put a haircut on this. If they owe it, they owe it. They're not going to overstate or understate this figure. So it's just the money they have, most of the money they're expected to receive, and then inventories at fire sale prices minus liabilities. Okay? And if you get a company trading at less than this figure, it's going to be pretty tough to lose money, right? Because this figure says, all right, if you shut down the doors tomorrow, sell everything off, collect what debts you can, what's the dollar figure? What are you looking at? Okay, and if you could shut the doors, close everything out for $10 a share, and you can buy the stock at 5. It's a pretty good opportunity. Now Bob's asking about long-term liabilities. Yeah, Bob, it's total liability. So on the balance sheet, you'll see short-term and then long-term. Then there's a total liability. So it's both short and long-term. And then the second component of that, so which is book value, right? And this is essentially tangible book is another valuation model to do. It's very similar to this, but it doesn't take quite as severe of a haircut. So it just removes the intangible assets from book value, but it doesn't. It gives you full value of accounts receivable. It's giving you full value of inventories. The cash and liability is the same, but it's not discounting these things, and it's giving you value on property, plant, and equipment, and other assets that aren't counted. So tangible book is kind of a similar way to do this. It's a little simpler. You're going to get a higher number, but it's kind of a quick and dirty method to doing it. So these are really the only two you want to use for net nets and asset plays. I mean, you're just basing it off of the balance sheet. What is there by book? What is it worth if it closed its doors tomorrow? And can I get it at a discount of that? Now, what do you want to look at for these? Well, you want to look at the income statement, okay, to make sure they're not bleeding cash. All right, if a company is worth, let's just say on paper, using this net current asset value, let's say it's worth $10 a share. All right, and the stock's trading at, say $5. That's kind of a no-brainer. You buy it at 5, look to flip it out at 10, and you're looking at trying to get 100% return. Okay, but if this company is losing, $4 a share per year, then that $10 isn't going to be there very long, is it? That 10 is going to turn into 6, and it's going to turn into 2, and this value is going to be eaten away because they're bleeding it out in losses. So that's really all you want to use the income statement for, and the rest of financials. Just make sure they're not losing. They don't need to be making a ton of money as long as they're just staying afloat and not losing a very small amount. It's generally a pretty safe place to put money. Let me answer a couple of questions in here. Really quickly, we'll move on. Is it being? Yes, the webinar is recorded and will be accessible later today on the homepage. Bharat, all the variables you mentioned you got from the income correct. Why aren't you using Apple's weighted average cost of capital? Brandon, just a different. It's a different valuation metric. Cyril, given risk-free rates in the mid 3% range, using weighted average cost of capital would get well below 9 to 12% discount rates to apply to your discount cash flow. Are you assuming a more normalized rate structure to discount your cash flows? So yes, we're using it. I mean, the 9% is we generally don't alter year to year. Okay, so the risk-free rate is just, and the main reason you use 9 to 12 is that's about what people expect on invested capital. Okay, if you look at the historic returns of the stock market for the last 100 years, you'll see about a 9 to 10% average return on the stock market over that amount of time. So people are going to invest in equities. We want to use a more severe discount rate to imply that additional risk. Ashmet says, so typically in the discount cash flow calculations provided by the Guru site, do you add the tangible asset value to calculate the margin of safety? No, the tangible book value is not added by default. Michael, regarding the terminal growth rate, if someone valued a stock 10 years ago and expected a terminal growth rate of 4%, does it make sense that a new investor valuing the same stock today starts with a new growth rate of 10% for the first year? So Michael, it's a very good question. And what he's saying, if we did this model right here and then fast forwarded to 2024, is someone going to start off with 10% again and get a higher value? So good question. Now this model assumes that starting in 2024 they're only going to grow at about 4% a year. And if that is correct, you'll begin to see that reflected in the numbers 10 years from now. Now, if we get 10 years from now and the company's showing no signs of slowing down growth, and fair estimate is we think maybe it'll grow at 6-7% for the next 10 years. Instead, the value is going to be higher. But if it has already slowed down, it begins showing 4% annualized growth, then you may start there as a more mature company. Mo, yeah, the screenshot's taken a couple months ago. That's why these figures are off. Darren, is there somewhere on GuruFocus we can look at the historical growth rate on a stock? Yeah, absolutely there is. Using the Apple example, if we go to this stock and just go to the 10-year financials, it's actually on the discount cash flow tab, so you can either go here or here. I'll show it to you on the discount cash flow because that's what we're talking about. All these growth rates are right there for you. Okay, so right here is a table showing you the 5 and 10 year and 1 year growth rates of all, revenue, EBITDA, etc. Michael, is the term discount rate the same thing as my required rate of return? Michael, yes and no. I mean, if you're looking at free capital, yes, it's your minimum required rate of return. Here's the thing: if you discount things by 12%, okay, and you're saying that equals your minimum rate of return is 12%. If you bought a stock at fair value at that price, then yes, you would expect to make about 12% a year. But if you need to make, say, 25% a year, then you'd want to buy this thing when it was down at 500 or so or at a discount. So you'll make the 12% that you cooked into the fair price and also the increase in share price. And core, is the purpose of the discount cash flow to ascertain on what I would pay for something today, assuming it's producing free cash, which is growing, blah, 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 blah. Yes, on core, it's correct. The idea of a discount cash flow is what is it worth to me today based on these assumptions. Not what will it be worth 10 years from now. What is that stock worth today with these assumptions built into it? Michael, you start out with earnings per share at the beginning, but it seems to be using free cash flow as drawn from the screen over discount cash flow values. Is that right? Michael, this actually does use earnings per share, but you can use free cash flow per share as well. You can change that input very easily. Just put a new figure in there. Some people prefer to base it on earnings since that's what Wall Street tends to follow. Some prefer the more Buffett approach of using free cash flow, but you can do either. Andreas says, many thanks for the webinar. I have a question. Why would you add tangible book value to the fair value calculated DCF model? Because either you sell the assets or use them to produce cash flow. So, Andreas, very good question. What he's asking is, in regard to the option to add this to fair value, he's saying that you shouldn't add it because you're using those to produce these earnings. Andreas, there's two schools of thought in that. I tend to agree more with you on this, with one exception. I will add in not the full tangible book value, but the kind of net cash position. So you look at a stock like Apple, they've got over $100 billion sitting there in cash overseas, and that's not money they need to use to do operations. If you took it away, nothing would change. So to me, whatever that works out per share, whether it's $50 or $60, that's worth adding to the fair value. Okay, that's cash sitting on the books, not being used, and I think increases the value of this company. But I do kind of agree with you on the fact that, look, if you're looking at property, plant, and equipment, and the value of those, they're going to depreciate over time, and they're being used to generate these cash flow figures. So yes, good question. Mohit, is there a best practice in computing the future growth rate besides using the historical growth rate? So, Mohit, that's a good question as well. And there's not an easy go-to answer here. A lot of people look at analyst expectations, what they think that company is going to grow. Obviously our job is to try to predict the future, not relive the past. For Apple, for instance, when we looked at those growth rates, I mean, their 5 and 10-year growth rates are 40, 50, 60%. And I don't think any of us believe Apple's going to continue to grow at 60% going forward. So there's not really a true and tried way to predict what they're going to grow, except to maybe find some happy medium between what they've been growing the last 4 or 5 years and what the market and analysts are predicting going forward. On course. So I assume it's fair to value a struggling business using a net asset value if it has negative cash flow rather than discount cash flow. Correct, Encore. Yeah, I mean if they're not generating any profits, you've got two options. It's either look at it as a net and use that net asset value calculation from before, or take some liberties in what you think they can do. All right. So if we've got a company and this figure is like negative $10, all right, so they're losing money. You're going to get like negative $200 here. You're not going to get a fair value because you're starting with a negative number. If that's the case, what I would generally do, what most people I think advise, is try to take a big picture outlook, look at what they've done historically, and try to make some easy, safe assumptions and say, okay, they're losing $10 a share now. Do I think they can return to profitability? If they do, what are we expecting them to make? Is there going to be any growth? And just change this number. Maybe they've made $5 a share for the last 7 or 8 years, and then this most recent year was a loss. Maybe you adjust this to like $5, or whatever your expectation is when they eventually turn profitable. John, why use a discount rate more than the 10-year Treasury bond rate? And John, it's a good question. I mean, the discount rate using the bond yield, which is somewhere around 3% or so right now, is just the risk-free rate. Now, when we use a discount rate, I mean, most people, I'm trying to think of the best way to explain this. You're thinking of it as what's the risk-free rate? What would my money earn otherwise? And really what you're looking at, the discount rate is more of what's the minimum I need to earn in order to be invested in the stock market. Okay, it's saying if all these values are correct and I've got a ballpark figure right, what am I going to earn on this assuming I paid fair value? Okay, so that's why I use a heavier discount rate. The other thing is it just cooks extra safety in. I mean, you could come in here and put a 3% discount rate on this, but you'd get a fair value of the stock at like $800 or $900. I mean, it's going to increase dramatically. Roger, how's automated growth rate determined? Roger, automated growth rate is based on EBITDA growth for the last, is it 5 years or 10? Charlie? The growth rate that's auto-calculated, it's the 10-year EBITDA growth rate. So that's why sometimes it may seem a little high. Minimum rate of return, exactly, Darren. All right, so let's go ahead and continue here. That's discount cash flow. Now the next model here is the projected free cash flow. Okay, this is looking at, it's a little bit more forecasting to the future. And this is the formula for it. So the value you're going to come up with is the growth multiple, how fast they're growing, times the free cash flow, and then adding in 80% of the total equity. All right, this is just a known model. We didn't create this ourselves. So the growth multiple is kind of the combination of EBITDA, revenue, earnings per share to give you a growth figure not based on just one metric. Free cash flow gives you the 6-year average free cash flow. And total equity, it gives you 80% of that. So it accounts, it's kind of a blanket accounting for overstated book value. And you can also click on the bar in the valuation box for more details, and you can do this for any of them. Here is that box that we mentioned and showed earlier. And watch when I click on one of these metrics, for instance, projected free cash flow. We just click on the green bar there. What it's going to do is take us to the precise to the penny value based on this formula. It's going to show you where all these numbers came from. It'll explain the formula. It gives you a 10-year price to intrinsic value range, showing you the highest it's been, the lowest it's been, the median, a full definition of this model, the cash flow figures that went into producing this, the value, then the actual coding behind it. And that's going to give you an explanation, show you the historical data and where it's at. So if this is, if you find valuation models you're not familiar with, you want to learn more about, I mean, Charlie's done a great job of putting all this together. So all this is very much clickable. The same thing for the Graham number and any of these other valuation models. It's going to explain this, show you the formula, give you all the data, so you can really dig into that deeper. But that's projected free cash flow. Now, another model that's very common is known as the median price to sales value, and this is really common with retail stocks. So if you're looking at a Best Buy or a Kohl's or Macy's, any of these large retail stocks, they tend to move more based on sales versus bottom line profits like a lot of other companies. And this is a formula for that: total annual sales divided by shares outstanding, so you get sales per share, times the 10-year median price to sales figure. Okay, so it says, hey, right now they're doing $5 per share in sales. They generally trade at 3 times price to sales, so it should be worth about $15. And here's an example of, well, I don't think there's an example, but again, works best for stable retail stocks. Really depends a lot on historical valuations levels. So you may have one retailer that tends to trade at 3 times sales, may have another that tends to trade at 1.5, and it's going to take that into account and very much value the stock dependent on where it has historically been. Now, one big thing, as I mentioned here, it does not factor in growth. Okay, it just gives you a ballpark figure for what it would be worth today based on where they generally value this company. If you're expecting better than or less than traditional growth, you'll want to adjust your value up and down. And again, you can also click that bar in a valuation tab. But for a basic example, I mean, if this company had $1 million in sales, and there is 100,000 shares outstanding, you've got $10 in sales per share, and then if it generally trades at 3 times price, but it should be median, generally trades at 3 times, and you can see these metrics, you get a value of $30. It's not overly complicated. It's just averaging this out for you. Now, another one that's really common is something known as the Graham number, and as you might have expected, this comes from Benjamin Graham. Now, he was not a big proponent of growth stocks. He was not privy to a time of Googles and Apples and 3D systems and drop boxes and the kind of growth we've seen today. So he generally focused on more stable companies. He's looking at railroads. He's looking at textile producers. So this is a model really that'll identify deals from the more stable companies. And this is the formula for it. And the reason it looks like this, Graham says you should not pay more than 15 times earnings per share. So a PE of 15. And he looked at the 3-year average to get that figure. He also believed you should not pay more than 1.5 times book value. But he said if you get it a lot less than 15 times earnings, you can pay a little bit more book. If you get it a lot less than 1.5 times book, you can pay a little more than 15 times earnings. So his thought was the product of your PE multiple and your price to book should not exceed 22.5. All right, so it's just 15 times 1.5 is 22.5. If 15 is higher and it's up at 20, then you're going to want, price to book really less than like 1.05. If price to book is, 2, then you're going to need earnings per share of less than, 11, or earnings per share multiple, price to earnings less than 11.25. All right, so that's how this formula comes from. Just multiplies tangible book per share times earnings per share times the 22.5, and then gives you the square root. So as mentioned, it underestimates growth stocks, right? Because it doesn't give you the allowance for paying a higher multiple for a company that's growing faster, and it also punishes light book value. I mean, some companies tend to be very resource heavy. They've got lots of PP&E, they've got lots of cash, they have lots of inventories. Others are not. So there's some really good companies out there that trade at 4 and 5 times book, not because they're inflated, just because they don't carry a lot of assets on paper. I mean, look at a Google. They generate billions and billions of money, but they don't need huge factories and warehouses and millions of acres of land and raw goods to do that. So they're going to trade at a higher book value. But for the very traditional, stable enterprises, this is not a bad way to value those. And again, you can click the bar, the valuation box, and it's one of the ones at the top of every stock. Now, one we added a couple years ago is under the Peter Lynch Fair Value. And Lynch, as I mentioned, is one of the best growth stock investors of all time. Earned around 29.2% for 13 years when he was head of the Magellan Fund. He was very much a value. He was disciplined on the value front when it came to growth investing. So his formula is pretty simple. He said the growth rate should be greater than the earnings multiple. Okay, so if you've got a stock with a PE ratio of 20, it needs to be growing at greater than 20%. So if you've got a stock, if the growing earnings at 30% a year, you can pay up to 30 times earnings. If it's growing at 15% a year, pay up to 15 times earnings. So what this does is just take the 5-year growth rate, and we look at EBITDA, it's pretty consistent, times the earnings per share. And since he believed the PE should be less than the growth rate, his model basically says the PEG ratio should be less than 1. P should be less than growth. So P divided by growth should be less than 1. And so what it does, it gives you a rough estimate for growth stocks. Very rough. It doesn't take into effect a lot of the macro principles, but it'll give you a ballpark estimate. And this does not look forward. It doesn't give you the forward estimate because, again, that's all based on analysts who may or may not be correct. We're looking at what it's done for the previous 5 years going forward. So if a company's earning $1 a share, they're growing at 20% a year, we'd want to pay up to $20. So So it's going to give you 20 times the dollar per share, and you're going to see a value of 20 bucks. And that's giving you a price. And okay, based on how fast they're growing, this is the most Peter Lynch would pay for it. So if you get a discount of that, it's generally a pretty good buy, assuming they keep growing. If it's a lot more than that, they're not expected to drastically increase their growth rate. You might be overpaying. And then finally, one more I want to look at is the Donald Yacktman forward rate of return. Now, Yacktman runs Yacktman Funds out of Texas, huge multi-billion-dollar fund, and he's kind of famous for something he created called the forward rate of return. And what it does is allow him to look at a stock and say, okay, if I bought this today, I'd expect to see about 9% a year, 12% a year, whatever that figure is. And the higher forward rate of return, obviously, the more attractive the opportunity. So this is a formula for that. His forward rate of return is the normalized free cash flow. In other words, what's it done free cash flow the last several years, averaged out, divided by the price plus the growth rate. Okay, so if a company's earning, about $1 a share in free cash flow, and it's a $10 stock, this right here is a 10% free cash flow yield, right? Plus the growth rate. So let's say this company's growing at maybe 5% a year. You add that, and then your forward rate of return would equal 15%. So it's just what yield are you getting, what is the free cash flow yielding now, plus the growth going forward, and that gives you Yacktman's forward rate of return. Now the normalized free cash flow is the last 7 years, so once again this is going to put a slight haircut to growth stocks. It's really going to forecast much better for consistent, stable businesses. The price is today's share price, and the growth rate is the lesser of per share or total revenue growth. So why do we use the lesser? Well, if they just did a really large stock buyback, it's not going to continue going forward. The per share rate will show to be faster growth than really took place. So we want to look at the lower of total or per share. But yeah, when he uses growth, he's looking at total revenue. Okay, total dollars in the door. So there's just another example. If they did $5 in free cash flow per share, and it's trading at $100, and the revenue is growing at 4.5% a year, you've got a 9.5% forward rate of return. Does that make sense to everybody? 5 over 100. This is 5%. plus the 4.5% growth rate gives you 9.5. So this can also be found at the bottom of the 10-year financials page. When we go through the numbers of a stock, and let's just use Apple since we're already on that page. If we go down to the 10-year financials, while the Yacktman forward rate of return is not here because it's not a hardball valuation price, it's just a forward rate of return, it can be found down here in the valuation window. Let's see where we've got it listed. Maybe we have it at the top. I might have misspoken. Okay, my apologies. It just didn't say Yacktman in front of it. Yeah, it's under the valuation ratios, forward rate of return, and it's going to give you the current one in addition to what historically it would have been valued at. Now look, you're getting some, this is Apple, this is why you have to take some of this with a grain of salt, and it's going to work better on some companies than others. Are we expecting 70, 60, 50% forward rates of return on Apple? No. Why is that? Because what it's using is the historical growth rate. I think most people are under the assumption that Apple is not going to continue growing at the rate it has been. However, if we look at a more stable business, let's look at Walgreens, for example. Walgreens is a much more consistent firm. It's experienced more normalized growth, and we look at their forward rate of return, we get a much cleaner picture of what we can expect. So we see at today's prices about 9.5% versus times when there was as much as 17, 15, 16% forward rates of return. But the reason it's lower today is because it's trading at a higher multiple of free cash flow, so the free cash flow yield is lower, even though the growth is about the same. So if you were, this is the Yacktman forward rate of return. If you're a bit overwhelmed with this stuff, you can start with the all-in-one screener. All right, that's a tool we have at GuruFocus.com. It's the best screener in the market, period. It's free for unlimited use for premium members. If you're not a premium member, just sign up for a 7-day trial, and you can use it for a week and run through it and see what you think. But the cool thing is all the valuation models we've mentioned can be scanned for using this screener, and they've also got definitions and tutorials available. If you click the question mark there, I'll show you what this looks like. If you go to the all-in-one screener, for instance, you like the Donald Yacktman forward rate of return, we can click on the valuation ratio tab here, and you see that we can scan using all these things we looked at. So price over net current asset value, price over median price to sales, the Graham number, the forward rate of return, Joel Greenblatt's earnings yield, price over discount cash flow, the Peter Lynch fair value, price to tangible book. So you can scan for these to immediately find stocks that are coming in as undervalued based on that. Just use a couple of drop-down menus with a minimum and maximum. So if you want forward rates of return of at least, say, 12%, you can check that box and immediately get a list of stocks that meet your criteria. Now you're going to want to limit these down, get rid of maybe the over-the-counter stocks if that's not really your wheelhouse. Maybe you want market caps of large firms, so 20 billion and larger, and then you want maybe low price to book or something fundamental to give you some safety. You can break that down as well. So maybe you want it less than say twice book. And then you've quickly dwindled this down to a list of 50 stocks, meaning your minimum rate of return based on Donald Yacktman's formula, that aren't ridiculously overvalued, that are 20 billion and larger. And you can do this with any of these. I mean, you can do it with price to sales metrics. You can do it with Ben Graham. If you want this price or median price to sales, if you want to say half of where it normally trades, You can find a list of those as well. If you want to open it up to smaller stocks, you can do that. If you want to dwindle it down by industry and then look at only retail companies, if you want to look at only manufacturing firms, we'll just check retail. And now we've only got the retailers trading at 1/2 of their average median price to sales. So what are we seeing? We're seeing companies that are currently in a little bit of trouble. JCPenney, Best Buy, Staples is on this list, American Eagle, Abercrombie and Fitch, and Coach. So if you're looking for undervalued retailers, this is a good place to start. But that's, these are the most commonly used valuation models that you're going to hear of and see quoted, and it's what a lot of the large hedge fund guys are using, especially the value-based managers. As I mentioned, if you're not a premium member, I'd encourage you to just take a trial. It's 7 days. You can cancel it on the phone, online, via email, no questions asked. We also have a 30-day money-back guarantee. But this will allow you to access all features of the website, including all these valuation models, the scanners to look for them, in addition to getting the real-time picks, the screeners, the strategies, Inside and Guru buys, valuation, monthly newsletters, all the features of the site there. And again, just put it in the paces, try it, decide if it's for you. You decide to stay with it, it's $349 per year, which is a bargain considering the amount of data and information analysis you're getting. We also have global membership for you guys who are either interested in international investing in various areas, or maybe you live internationally and want to focus on stocks in your area. And we have all the same tools and all the same data on all these different areas. So Canada, we cover the 3 exchanges there, UK, Europe, Asia, Australia. And these are just add-on prices for the various regions there if you're interested in exposure to that. Especially in today's market, things are a bit overvalued, and a lot of people are looking overseas for cleaner valuations. And again, these work the same way, same trial period, same money-back guarantee. The cool thing is you can add or drop them at any time, right? So if you're midway through your membership, you want to tack on UK and Ireland, it's not going to charge you $169. It's going to charge you, $85 or $90, whatever the prorated amount is to the end of your into your membership. And you can drop it and move another one anytime, and it'll refund you and fill the gaps and make all that easy. But those are the big valuation models and how to use them. With that being said, let me answer questions and see what you guys want to look at further. Mohit, are these values calculated on the fly, or are they computed periodically? No, they're done live. I mean, they're done when you access that page. Now, some of the data may be from yesterday's close if you're looking at it in the morning, but they are within 12 hours calculated. Yes. Mohit, can we exclude any one industry, for example, maybe exclude utilities? Yeah, if you're talking about the screener, absolutely. So what you can do here is when it comes to industry, let's unselect all. You can either select it all and just remove it, or you can go to the exclude tab, or the exclude button right there, and maybe you just want to exclude personal services, and it will remove that one industry from the list. Yeah, absolutely. Is there any chance in the future to provide analyst estimates for stocks? It seemed that if you like the discount cash flow model, which implies correctly predicting the future cash flow for the next 20 years, you could at least provide analyst expect for the next 3 years. Boy, yeah, there is some of that data. The thing is, it changes so often. Wall Street is very famous for, oh, that stock just fell $20. We're going to lower our forecast. Or, we're going to now rate it a sell, after the stock has already fallen and gone to good value. So we generally don't get into forward expectations just because there are so many different analysts out there. Some stocks would have no data, some would be based on one analyst's opinion somewhere, and others will be based on the average of 30 or 40 or 50 analysts. And that data just tends to change on a pretty frequent basis. Mo, real-time Guru pick alerts. How long does it take for GuruFocus to report this? So, Mo, good question. When it comes to the real-time picks, and he's talking about, if Buffett buys a stock or Soros, there's two windows there. So, first off, they have to report all their equity holdings on a quarterly basis. And when they do that, they have, I believe, 45 days to file that information. So the quarter ends March 31st. They have until May 15th or May 16th to file that. Some file it earlier, some wait to the last minute. Once it is filed with the SEC, it is on our site within the hour. It's automatically put on there. Sometimes we get real-time picks if a guru or an insider, if a guru buys a stock in a company in which he is either an insider or owns 5% or more of, which makes him an insider, he must report that within 14 days. And that, like the others, as soon as it's reported, is on our website within about 20 minutes. So, some you will get to the quarter end, others are updated more timely if they happen to be an insider, but there's no other way to get the information faster than that. Question from Giuseppe, any particular treatment for bank stocks? Not really. I mean, bank stocks, have fallen out of favor, and now a lot of people are buying them. Buffett's big in Wells Fargo and Bank of America, and we've seen a lot of other value-based gurus picking up those same stocks. If it's a really small bank that's not predictable, it's going to be tough. But if you really just want to focus on the banks that you believe have the least exposure, to some of those catastrophic liabilities we saw in 08 and 09, and there's light on the derivatives and a really speculative leveraged opportunities, and just look at what their cash flow is generating. When you do the DCF, the sale price is an extra to what you earned. And Tony, I'm not sure what you're asking with that question. I mean, the fair value is assuming based if it grows like you think it will, is going to earn you that discount rate per year. But if it comes up at 200 and you buy it at 100, if it happened immediately, your return should be about 100%. If it happens, over the course of a year or so, and the values increase since then, maybe you make 110, 115. Does the all-in-one screener offer any features not available in SI Pro? SI Pro. Yeah. Oh, yeah. I mean, this screener it's the best fundamental screener out there. One of the cool things, I mean, you can scan share buybacks, all the different scores, but one of the things I like is you can search based on company-specific criteria. Okay, so for instance, most scanners will let you search for, give me all companies that are trading less than 2 times book. But what this screener will allow you to do is scan for companies a certain percentage below their historical average price to book, their historical low price to book. So different companies trade at different valuations, and this is going to compare it on a company-specific level. You do the same thing with price to sales and then basic prices. You can also search valuation ranks. Maybe you want price to book better than 90% of the industry, or price to earnings ratio better than 80% of their industry. So it lets you compare BP versus other oil stocks while you're comparing JCPenney to other big box retail chains. So it's very sector and stock specific. How long will the presentation be on your website? The presentation will be on there. It should be eternally under the tutorial section. Mo, hedge fund is 90 days to report 13F to the SEC. Does it mean your guru pick alerts are also 90 days old? No. So, I mean, the picks we report based on the 13F filing are as up to date as you can get the data. The real-time alerts that occur when their insiders have 5% or greater holding are within 14 days of that buy. Does it show insider trading? Mohit, yeah, it does show insider trades, and you can scan for that. You can click the insiders tab here and look for a certain number of insiders that are buying. If you want CEO buying and how many shares, the CFO, total insider buys and sells, and you can also set the duration, the last 2 weeks, the last 2 months, 3 years, whatever you choose there. Antonio, do analysts use this valuation methods? They have their own. No, Antonio. Generally, they're using some variation of one of these. Now they've got models that are industry specific, generally for what they're looking at. So they may, if they're doing retail stocks, they're going to base it on what they think for the growth rate in the DCF, they're going to use what they think the industry is going to grow and what they believe this company is going to grow. For the price to sales figure, they're going to use what the average price to sale is in that industry and historically. So yeah, they're typically using the same types of models. They're just doing a lot more work to get their data. Judith asks, does your data include the percentage of institutional investors? Yeah, if you click on any one of these stocks, there's several tabs across the front. So you guys may not know how to use the full features of the site, but one of these is short interest here will show you that. And if you click on the short interest tab, it's going to show you the percentage of the stock owned by institutions, the percentage held short, and then the percentage held by insiders. And in addition, it's going to give you history of both institutional and short interest and insiders, so you can see where this has historically been and kind of where it's trending now. All right, well, I appreciate all of you joining us for the webinar. I hope this has shed some light into various valuation models and how to use them. Again, all of this stuff can be found on the website. If you click any one of these bars up here, it will take you to a detailed explanation of what this precise value is, how it is calculated, and what it's historically looked like. There's also a tutorials tab that you can find anything. So if you hover over this home button here and select tutorials, you don't have to dig through these one by one. Simply use the search box at the front. So if you're looking at DCF or discount cash flow, it's got reverse DCF. It's got various features and dictionary terms here. If you want to look at the Yacktman forward rate of return, just begin typing Yacktman, and you can see it's going to show you new features and financial dictionary of the terms and various explanations of that. So I encourage you to use that going forward if you have any issues with some of the terms or some of the methods you're seeing there. So thank you all for joining us. The webinar will be available on the home page this afternoon. You'll see right here in the front right this video replaced with today's, and you can access it there. You can also hover over the home button, go to tutorials, and see the replays of all previous webinars that are archived here on the tutorials front page. We appreciate you joining us, and you guys have a wonderful rest of your Wednesday.